Welcome, everybody. It is Wednesday night, and this is the Educated Homebuyer Live. You will soon notice that we are one man down. We also had a little bit of confusion. Somehow the show got inadvertently scheduled for 2:25 in the afternoon instead of 5 p.m. So hopefully everyone finds their way here and knows that our typical time is 5 o'clock. I don't know how it got scheduled incorrectly, but here we are. So you may be asking, Josh, why are you here by yourself? It's because my co-host here on the Educated Home Buyer, if you're watching on Jeb Smith's channel, on the host and the owner of this channel, Jeb Smith, he and his family are in Palm Springs, spring break with those three dudes right there. So a little sun, a little golf, a little hanging out with the family and some family friends. So he will not be with us today, but he has been kind enough to share all of the notes on all of his slides. So we're going to buzz through that, and hopefully we won't miss his knowledge too much with him having shared that. Now, on the flip side, I do not have any children. That is my one and only child there, Peanut Lewis. So her mother and I are having a little bit of withdrawals. She went away to school to get trained for the next 3 weeks today. So her mother and I had a rough time. So if you can keep us in your thoughts and prayers, we're hoping we can make it through the next 3 weeks. And she comes back an even more perfect angel than she was when she left. So with that, let's jump right into the data. So this is showing available inventory, and I've got a couple additional slides I threw in here that will give you another look at it. We are showing 517,000 available inventory across the country of single-family homes. It's 26% more than a year ago. Inventory has been increasing for 20 weeks in a row. That needs some context, and we'll provide that context with some of these other slides. In the available inventory chart, you'll notice that by August, we would see close to 700,000 homes on the market. If rates were to fall, demand would increase and the inventory expansion trend would reverse. So the longer we stay at higher mortgage rates, the closer we're going to get to the old normal levels of inventory we can get. So while inventory is increasing, it's certainly not anything to be concerned or alarmed about. It should be something to be celebrated for those buyers that are out there and qualified and looking to buy a home in the current market. Then we have a few more homes for them to choose from. So this week, inventory rose from 512 to 517,000, so a little less than 5,000 increase. Same week last year, we fell from 413 to 410, so certainly more healthy than where we were last year. The all-time inventory bottom was in 2022, 240,194, and the peak for the year of 2023 was 569,898. So we're still 50,000 or so below that. So we had 18% new listings growth over the same week a year ago. Sales pace is also accelerating. So this is the chart that I wanted to show you guys and say in terms of context. So this is the first 14 weeks of each year going back to 2017. So we're at 58,000 new single family plus 15,000 new condo listings so far for this 14 weeks. And when we look at it, you can see that it really isn't even getting us close to what normal looked like for 17, 18, 19, and 2020. 2020, take it with a grain of salt because those first 14 weeks of the year were normal, but that was about when everything went crazy. Wanted to show this new listings by month, according to Realtor.com. It's data from Resi Club. They pulled it and presented it in a nice format for us from Realtor.com. But you can see we are still well below those past years. It looks like the only year that we're above there is last year, 2023. This is a good thing. We want to see it increasing. You see sort of the shape of all of these charts, other than 2020 that had this big dip here right when COVID kicked off. The shape of those charts is all very similar. That seasonality is pretty consistent. It's the levels of what we're seeing, and we're seeing a normal increase in inventory for this time of the year. New contracts pending. You can see again here, more homes going under contract than what we saw last year, a little bit less than 2022, but that's because this time in 2022, we had rates at least 2%, probably more like 3.5% lower than where we're at right now. Median price is 393,775. Home prices up 5% over the last year. You probably get tired of us saying it here on the show. We don't love median price. It can reflect sales mix more so than it reflects actual changes in pricing. So looking at this one, percent of properties with recent price reductions. So this has ticked up, and this is funny. I actually saw someone comment on this chart on social media today that this is an alarming uptick. It's not an alarming uptick. If you look at it, we are higher than what we've seen over the last several years, which was a very hot market. We sort of crossed over where we were last year. But that gray band tells you we are in the normal range of 30 to 35% of homes with a price reduction. Definitely bears watching. If this continues to increase, when we shoot out at the top of that band, that would tell us something about the market. The increase over the last few weeks, again, that trend relative to the last several years looks very, very similar. So with that, jump through this one here. I thought it was a really good chart that we saw from Calculated Risk earlier in the week. Homeowners with mortgages. This is only homeowners with mortgages. So remember the last line there, nearly 40% of US homeowners have no mortgage. So of the 60% of people who do not own their home free and clear, over 69%, so 70% owe less than 60% of their home's value, meaning they've got more than 40% equity in their homes, and 91% owe less than 80%. So no matter what happens in terms of distress, we are not looking at a situation where we're likely to see short sales or foreclosures, because 91% of people have more than enough equity. You need anywhere between 5 and 10% of equity to be able to sell your home at market value. So those home prices could drop 10% before people will be looking at short sales. And there are certainly irrational foreclosures. There are people that will just ride it to the bitter end and get their home foreclosed on when they could have done an equity sale. But we just don't have a recipe for that. The next chart here is going to actually show, the next one after this is going to show sort of lock-in effect and what we're seeing of people not wanting to move, why we have very low volume and low inventory relative to low demand, kind of keeping prices on that slow upward tick at 5% year over year. But this shows that 86.6% of more outstanding mortgages have a rate below 6%. The important one are those 2 to 3 blue portions of it. So 22% with rates under 3%. I have a 2.875% rate on my primary home, and that's a pretty strong reason to keep you there. We saw some numbers. I didn't throw the chart in this week, but some very good numbers showing in terms of what it would look like for someone right now with a mortgage like mine to buy the exact same house. It would be about a 41% increase in their home price or their monthly payment. So from that perspective, you see why people are locked in. We've got 35% of people with rates of 3 to 3.99 and another 18% from 4 to 4.99%. So this is the lock-in effect visualized, how the difference between the prevailing mortgage rate and the effective rate impacts home sales. So this shows you even here, like if you look at the middle, that last dip before the big giant dip here was about 2018. We saw rates go up to about 5% at that time. And we saw effectively a 10% decrease in sales volume because of the lock-in effect at 5%. Well, now you can see over the last couple of years, a couple forays over 7%, all the way up over 8% or close to it at one point. And you're seeing here, we are at a 60% reduction, a 55, 56% reduction of what we would normally be seeing in terms of sales volume if rates were closer to where most homeowners are at currently. So in terms of looking at it, we would cut 15 basis points off of the lock-in effect if rates dropped 1%. If rates were to drop 2%, you'd get down and have only about a 25% of the lock-in effect. So about half of what we're seeing right now. Thought this one was interesting. Everyone's talking about homes are incredibly unaffordable. No one can buy them. Who can afford? We get that question often from nearly every week. This shows that the data here, this is from Moody's Analytics, and it is still showing that homes are overvalued by about 10 to 12%. We talk about affordability. There's only 3 things that can move affordability. Wages can go up, interest rates can come down, or home prices can come down. We know interest rates didn't come down. We've seen in those charts that home prices haven't come down. So the only thing that's happened here is we've got 2 years down the line and wages have gone up and caught up to where we're at. So if and when we do get a small moderation in home prices, a small moderation in interest rates, and hopefully incomes continuing to go up, we'll see this get back closer to the trend. Because for everyone out there saying, oh, it's going to be a crash, too high, the prices are too high relative to where they've been, we will always say that it comes back to supply and demand. So the homes that are owned are in very strong hands. They don't have to sell. They have strong incentives to stay where they're at. So if they're not selling, despite the fact that we have really low demand relative to historical levels, we also have really low supply. So hopefully affordability comes into line. And because of that, as they get more balanced, we probably shouldn't have a big run up in prices either. We still have a big structural deficit of homes here in the US, But with that, if more people are incentivized through their life changes, life stages to bring their homes to the market, as these become a little bit more affordable over time, hopefully we'll see a nice balance there for everyone. So we start talking about economic data here. Wanted to point out, so today or tomorrow, Thursday, April 4th, just through the yellow box on there, not really anything that's going to be a market mover. The big market movers have the yellow star on there. Today, we're going to go through the data. We had the ADP jobs report. So with that, we'll go through. We had the ADP jobs report. We had a speech from Fed Chair Powell today. So we can show you a quote in there of what he's thinking at the current time. But not much tomorrow, so probably going to see another flat day. We had two bad day Monday, flat day Tuesday, flat day Wednesday. Likely to see a flat day tomorrow, but on Friday we get the big one. There's really only two things that the Fed's looking at right now: employment, which their measure is the NFP report, which comes out 2 days after ADP. So we get that on Friday. So they're going to be looking to see how many jobs were created. Did the unemployment rate go up? What is it telling us about wage inflation? So we'll see that on Friday. So let's look at that ADP report. They were expecting, if I remember correct, well, actually, we've got the number here. I cut it off. I believe they were expecting 150,000 job creations. It came in much hotter at about 184,000. The bottom half of this chart is more important. It shows what happened in terms of wages. So the gray bars are for people who are changing jobs, and the black line is people who stay on their jobs. So the trend for people staying on their jobs stayed pretty darn consistent. We had seen wage growth decreasing, still up, but growth decreasing for people who were changing jobs. And we saw a spike last month up to 10% pay raises for people who were willing to change jobs. That, if that is borne out in the NFP data on Friday, could be inflationary. So it's going to be important to watch. So what are we looking at next week? Next week, we also have some really important data. It's not until Wednesday, but we get CPI. So CPI is not the primary measure that the Fed looks at. They prefer PCE, but for whatever market or for whatever reason, the markets have been trading CPI much more than they've traded PCE. So if this comes in about where it's expected, probably not going to see much movement. If it was somehow magically lower than expected, which if you look at the underlying things happening, oil, energy prices have crept up, which doesn't show up in the core, but it can trickle into other things because energy is used in almost every good and service that there is. But looking at that, that will be our big number. So in the next 3 days, 4 days, 5 days, next 5 trading days, we're getting the two most important things that the Fed looks at. So on this, we're talking a little bit about increased energy prices. Oil is up. We're coming into the time of year when people start traveling more consumption of gas. So gas prices are up. But when you look at this, other than 2022, that top aqua line there, gas prices are behaving pretty normally to what we would expect. So no one likes paying more for gas through the summer season, but that chart looks pretty similar to what we would expect. If oil keeps going up, may go higher from here, but we'll have to keep an eye on that. This, we haven't shown this for a couple of weeks, but I wanted to throw it in here. So Trueflation has, I believe it's like a 0.97 correlation. So like a 97% correlation to inflation as measured by CPI. And we had a huge run down here, and now we've kind of leveled off. We've talked about this bouncing around. Their figure as of today is at 2.086. That's what the Fed would like to see, but the Fed doesn't care what Trueflation thinks, even if it does have a 97% correlation. For them, they're going to be looking at CPI, they're going to be looking at PCE, and until we get the core levels there closer to 2%, which realistically, it's looking like we're probably going to be into 2025, maybe 2026. One of the Fed members, Raphael Bostic, was out speaking yesterday, and he said he doesn't think it's going to come until the end of 2025. Now, those folks don't have a monopoly on knowledge, but they do have really good data, and they are trained economists. They know what they're looking at. So it'll be interesting going forward. So this is what I was talking about today. Fed Chair Powell was interviewed, and he said, the recent data do not materially change the overall picture, which continues to be one of solid growth, a strong but rebalancing labor market, and inflation moving down towards 2% on a sometimes bumpy path. So it kind of tells you why we're trading sideways. We're not seeing improvement in interest rates. They've crept up a little bit, but not anything appreciable where you'd say, hey, rates are spiking. We're just kind of stuck here until we see some of that improvement that the Fed wants to see. This green line is a very critical technical level. So we closed just above 434 yesterday, right at 434 today. We talked about probably not going to move much tomorrow in anticipation of Friday's NFP report. If that report comes in tame, we should drop below it. If we get a hot jobs report, like that surprisingly hot jobs report in January, we can probably expect to blow this 434 level, and the next technical support or resistance at that point would be 465. So about another 0.3% higher in the treasuries, which will trickle through into mortgages and take them at least another 0.25% higher. So watch that. If you see the market react well to the jobs report on Friday and we bounce under 434, we could see some improvement down maybe about 0.125% in interest. So what does that mean in actual real interest rates? We have the 30-year fixed, according to Optimal Blue, at 6.86, and their data is as of yesterday, which again, we said it's flat, not a lot of movement. Mortgage News Daily is reporting 7.07 as of today. And FHA is at about 6.5 and 6.625 for Optimal Blue. So for most of you out there, depending on government loan, conventional loan, you're looking somewhere between 6.5 and 7%. And for those with better credit, shouldn't have to pay a point. But that obviously changes as we go down the credit scale. So that's really all we got today in terms of the slides. So check in here, seeing we don't have a whole lot of comments. We don't have a whole lot of questions. I think a little bit of the mix up on the timing of the show got us off to a little bit of a late start here, but no questions. If you have a question about mortgage rates, question about the economy, how that's going to impact interest rates, go ahead, throw them in the comments. Would love to get you some answers here. For the time being, let's throw it in here. Agent Crypto says, love the channel. Remember, people, now is the best time to buy before rates go down and more buyers come off the sidelines. There's definitely truth to that. We've seen every time rates have dipped, mortgage applications have gone up. We had that nice dip in the fourth quarter of last year. We got through January, and January was very strong for putting new homes under contract. So I do think due to affordability, we have sort of a limit. It's not like home prices are going to skyrocket, but it's not going to get easier if and when interest rates come down. So from that perspective, definitely appreciate the advice there, Agent Crypto. Appreciate the support and saying that you love the channel. We do appreciate that. So seize the day. I like that little play on words. Seize the day. Do you feel spring market listings will start picking up or remain light, especially with interest rates floating back up? I'm worried with recent upticks, we won't get cuts, rate drops, and inventory will remain low. Hard to argue with that logic there. I do believe what we were seeing, 2023 was the worst of the lock-in effect because people were looking at it in disbelief that in 1 year, early 2022, we're at 3%, middle of 2023, we're at 7.5%. And they're going, what in the world just happened? This can't be normal. It's going to go away. I'll wait till rates get back down to 4.5. I don't expect them to go to 3, but I'll wait till they get to 4.5. Some of that increase in listings that we're seeing this year is that folks are having life events happen. If you get married, you have a kid, you get a new job and get moved to another city and you get a $30,000 pay raise, you're probably going to go regardless of the fact that your housing payment is going to go up. So all of that, death, divorce, bad, good, all of those life events force people to move. And I think the people that sat on the sidelines through 2023 are just realizing that life stage and life events is trumping optimal time. We've talked about here on the show. Jeff bought a new house. I've got a friend that he's getting married. They're doubling the family size. Both he and his new wife or wife to be have multiple children, and they don't fit in either one of their houses. So that's just the reality of it. Is there any hope for more listings? I think they will continue to trend up. We see it in the charts. I don't think it's alarming, but just got to keep watching it. Let's look here. Ja says, how soon after rates are cut / increased will mortgage rates be affected? So think of it in this terms. The market is always looking forward. So a lot of times it's buy the rumor, sell the fact. So if there was a rumor or a concern that that jobs report was going to be super hot on Friday, we would have already blown that 434 level. And if that were the case, mortgage bond traders would be doing the same thing that traders in the treasury markets would be doing, and they would be selling. So they would lower prices, higher yields, and interest rates would have already gone up. So we had a hotter than expected PCE report last Friday. Not so bad that it blew things through the roof, but markets were closed for Good Friday. So on Monday, we lost about 50 basis points. So what would have been 0 points on Friday was looking at about a half point on by the end of trading on Monday. And the reality is most people just say, hey, no, I don't want to pay a half point. It's about 1/8% higher in interest rate. So again, buy the rumor, sell the fact, and the market does not wait for Fed cuts. They're trying to anticipate what is coming next. So you'll see markets adjust to it well before the Fed actually gets around to cutting. So Agent Crypto, what's the typical cost to refinance? Never done one before. Also, at what point would it be beneficial to refinance? It's one of the number one questions we get on the show. We have a super simple rule of thumb. Take $125,000 and divide it by your loan amount. It'll tell you how much you need to drop your interest rate to give you an idea of when you should be looking at refinancing. So if you have a $125,000 loan, small loan. So to get enough benefit to make it make sense, you're going to need almost a full percent move. If you have $1 million loan, 125,000 divided by $1 million is only 0.125% move in interest rate. So that takes into account that we have different loan sizes, and that monthly savings is going to be the determinant of whether someone thinks it's worthwhile to go ahead and do that refinance. Now, in terms of the cost, it can vary significantly on types of loans. If you're getting a VA IRRRL or a FHA Streamline that doesn't require an appraisal, that's a nice cost savings there. So let's say on the absolute low end, you're probably thinking $1,500. On the high end, $4,000 to $5,000. If it's a bigger loan, and in some parts of the country, they actually have some taxes on refinances. So it's not going to be a super helpful number for you, but depending on where you are in the country is going to dictate that. And remember, you always have the option of taking a marginally higher interest rate and getting your costs covered. We locked one earlier this week for a viewer of the show that bought in the fourth quarter of last year. They're just hitting their 6-month mark, and we're able to do a no-cost loan and drop their rate at 0.5%. We did no cost versus doing the lower interest rate because they're thinking, probably correctly, that rates are going to move lower, and they didn't want to pay for a refinance now and feel like they had sunk costs going into the future. So let's roll through these. We got a lot of questions. GD says, got my home in the market last Friday, got a VA loan assumption offer, and I accepted. Well, hey, I like that. So you had an awesome interest rate, and you were able to use that to help you get a buyer. Buyer showed proof of funds for difference of loan amount and sale price. I've never seen pros and cons. If they've shown you the proof of funds, there's really no issue there. They're going to come in and pay you the difference between the sale price and what you owe. There's a couple things here you want to make sure as part of that assumption process. You need to make sure you get a release of liability from the VA. That's releasing you from being responsible for that loan. And it sounds crazy, but people go through that process and don't get that release of liability. The other piece, you didn't mention whether the buyer is a veteran. If the buyer is a veteran, you want to make sure they substitute their VA eligibility for yours so that you get yours restored and can go on and buy another home with no limitations. So those would be the two things that I would be thinking in terms of on that. Now we've got scat action. I'm currently under contract on our first home in Virginia. Got a 7.7% interest rate with a 100% financing loan, so we don't have to pay any down payment. Is that a good deal? They keep everything in context. That's a high interest rate. We just showed that the market's somewhere around 7%. You said it's a zero down loan. Zero down loans are not a common thing out in the market. There are different ways of doing it. The most common way is FHA financing with some type of secondary financing that has no payments or even no interest rate. But to cover the cost of that, you generally end up paying a higher interest rate. We had a training call earlier today with a big national wholesale lender. They've got a really good program that does exactly that. But you, again, would be mid to high sevens versus a lower interest rate. So the things that I would say to make sure of, if there's a second lien, will they subordinate to the first lien? What are your options in terms of refinancing? Because obviously your hope would be that rates are going to go lower in the future. You just want to make sure that this loan doesn't in any way lock you into that interest rate for the long term. But in terms of context, is it a good rate or a bad rate? It's allowing you to get into the home and it's not a bad rate. Let's say that. And without being in Virginia and knowing all the options, I don't know what other options you may have, but there aren't a whole lot in terms of zero down. Smart Fox says on Prop 19, can I buy a house before I sell my primary house within 2 years? That's a really good question. The Prop 19 is relatively new. Previously, some counties in California had a reciprocal agreement where you could transfer your Prop 13 tax base, and we were more well versed on those guidelines versus under Prop 19. What I would say, Smart Fox, shoot an email to info@theeducatedhomebuyer.com, and either myself or Jeb will get you the right answer to that. I'd hate to give you the wrong answer right now. Partially saying I believe you can, but I wouldn't go too far out on a limb with that. Joyce, a regular viewer here, says, do you think that the Fed will actually cut rates before the end of the year? They seem, I'm not sure what the last part is, but do I think they're going to? I do. Even Bostic, who is probably one of the more hawkish, Loretta Meester is probably the most hawkish. Right behind that is Raphael Bostic. And he still thinks we're going to cut once and probably in the fourth quarter this year. We had two other Fed speakers, and I do not remember which ones they were, but two other Fed speakers that were out talking today, and they still think we're going to see 3 in the second half of the year. I didn't throw the chart in from the Fed futures markets, but the Fed funds futures market is predicting 62 basis points of cuts. So 3 cuts would be 75 basis points. So the futures market is saying, hey, we don't see 3 this year. So at this point, do I think it's coming? Yes. What I will say, you've probably heard us say over and over again, we're getting conflicting reports. We're getting reports that don't make sense, like that January jobs report for December of last year. And we also get things that are saying that the market is strong, market in jobs, that inflation is picking up. So for every report we says that things are slowing down and inflation is decreasing, there's another one that kind of gives a mixed signal. So for that, I think it's pretty rational that we're seeing this sideways market and cuts getting pushed out further into the future. Beyond that, just keep watching the market and see where it goes from there. Enough time travel says, for home renovations in your area, have supply and contractor availability returned to pre-2020 levels? For us here in Southern California, a mixed bag. For high-end contractors, they are still very, very busy. Cabinet makers, finish carpenters, any and all of that, those folks are hard to get a hold of and still get to name their prices. I had a new vanity put in one of our bathrooms about 6 months ago, and he said he was still busy, but didn't have the backlog. He said that was, alarming him. Have a friend and borrower who we just closed a week ago doing a cash out loan on a property that needed a bunch of renovations that they inherited from a family member. And he had said that he was somewhat surprised on how negotiable things were with the contractors, that they were doing a fence and some painting. So not major things, but they were actually relatively flexible and negotiable. So I definitely think it's better than it was. We're not to the part where contractors can say, here's my price, take it or leave it, because I've got 14 other jobs lined up. But they're definitely, most of the good ones are still fairly busy. Remstar like this question. Do you think the Fed may break something, meaning rates were kept too low for too long? Wonder if they will keep it too high for too long. Right now, the Fed is feeling really good about what they're doing. They've brought inflation way down from a very high level. It's not where they want it, but it's much, much better. At the same time, they haven't broken anything. So you're right to say, looking forward, if we do not preemptively cut, if we do not ease conditions earlier than it appears to be needed, can you have a big spike in unemployment? Can we slow the economy down to a halt? I would lean towards believing that that's likely to happen, because I don't think they are going to cut until they see things slowing. And it's almost like, the cat runs out in front of you, you wait till the very last second to slam on the brakes. Cat's likely to have a bad ending. So from that perspective, I think we're playing with fire, but I also understand from their perspective, if you go back, I think we've shown the charts on the show here, back in the 70s and 80s, we had 2 bouts of rebound inflation. And those Feds who were in charge when that happened are not looked back on fondly. And Powell, whether I think it's 2 years that he's up for it's not reelection, reappointment. Don't think he wants to be reappointed. Friends, if that's the way the election goes, he's not going to like that. And he's just a little bit older. I think he wants to get through these last 2 years and leave a legacy of, yes, Maybe we were too low for too long and let inflation get out of control, but we did what we needed to do to get it back under control. So, Wesley, my friend, where have you been? Have you been here? Have you been watching the last few weeks? I was thinking to myself last week, I haven't heard Wesley say anything terrible about how my Clippers went from being awful the first month of the season to amazing for the next 2 months, back to being an awful team who it appears as though we're going to get bounced in the first round of the playoffs. So good to see you back, Wesley, whether you were here and not commenting or actually gone, but never going to get a chance to refinance your 3%. You're a young man, Wesley. I wouldn't give up on it. We talked about this a lot last week in that the two sort of contrasting things here that are pulling on the market is demographics. Everything other than excessive government debt would point to continued lower interest rate trends. But the government, I saw a projection this week, and the projections have generally been consistently too low, that if they don't do anything drastic, which they haven't even talked about doing anything, much less anything drastic, by 2050, we're looking at $141 trillion of debt. So if you think $34 trillion is bad, wait till we get $141 trillion and the supply of treasuries that brings to the market and what that does to interest rates. The long-term fear has always been government spending. They have to borrow. Someone has to finance that. So there's too much supply of treasuries. The bond market can't absorb them. Yields have to go higher. What we actually saw over time is that excessive government debt was taking money away. The interest to pay back the debt was taking money away from productive purposes, slowed the economy to such a point that it brought interest rates down. So those are the two sort of diametrically opposed forces that we're dealing with right now. Smart Fox has a question. Should I check if there's a lien on my house before I sell? How do I do that? If someone put a lien, do they notify you? Someone can go to the recorder's office and record something against your property without your notice. If you're looking to sell, when you're interviewing realtors, ask them if they can pull a property profile. I can pull a property profile. So if you have a lender you have a relationship with, say, hey, I'm thinking of selling my home. Can you pull a property profile and just see what liens are showing against my property? It's a pretty easy one. Holly says, that's us. 2 kids, moved back, 1 pregnant, and we were in a 2 and 2. We found the perfect homeowner is letting us rent till ours sells, but we need to sell, plus interest rates to go back down to not be house poor. That's not uncommon out there. Life happening and forcing people to move, regardless of whether the timing is optimal for prices and interest rates. Job back with another question here. If I lock in my rate, could my mortgage broker move my loan if rates later drop drastically? Yes, they can. They shouldn't. Our agreement, so on the wholesale side, as a broker, we have agreements with a lot of wholesale lenders, many wholesale lenders, I should say, and we can place loans with them. And it says, once we lock that loan with them, if we close it, we are committing to close it with them. Now, there are many brokers out there that don't follow that, and they are willing to burn a relationship and say, hey, rates dropped a bunch. I'm going to take it, pull it, put it somewhere else. So does that mean that you're stuck if rates drop a bunch? You are not. Every lender that we work with also has a renegotiation policy, also known as a float down policy. They don't want to lose that loan. They want to make sure it closes. There's no such thing in the real world as a rate lock. They don't go to some desk there and say, hey, lock this interest rate for this time. They're having to put hedges on in the secondary markets against the potential for rates to go up. There's a cost to that. So their profitability goes down if they have to renegotiate locks, but at the same time, their profitability goes to zero if they don't close loans. So they want to negotiate and work with you. If you are working with a broker who is suggesting, hey, I can just pull the loan and put it somewhere else if rates drop, I would question the professionalism and integrity of the person that you're talking to, because hopefully they're telling you more likely that once we lock it, if we see a significant move, we can get a renegotiation with the lender that we're with. Red Apples Kim, another one of our all-star regular viewers, back with a question. Josh, on one of my credit cards, my credit limit decreased, which makes my credit score decrease due to lack of real estate. Have you ever heard of that? Not lack of real estate. What happened there, if your limit decreases, so let's just look at it this way. It's an extreme example. If your credit card has a $10,000 limit and you owe $2,000 on it, you only are using 20% of the available credit. If they cut that limit to $2,500 and you owe $2,000, you're now using 80% of that available credit. It's not that they're looking and seeing that you don't own real estate, although the type of credit mix is considered. So if you had a mortgage an auto loan, and 2 credit cards is sort of optimal so they can see that you're using different types of credit. But I don't think that it's the fact that you don't have real estate in there, um, real estate in there that's causing an issue for you. Let's look here. We got a bunch of questions. I want to make sure we get you guys all answered. Appreciate you all showing up. This is a good time to ask. If you're here, make sure you like the video, throw a thumbs up in here. It helps the algorithm throw it out to more people in the feed, more people to see it, hopefully get the information they need so they can also become educated home buyers. Also want to throw this up here. Where are we at? If you are anywhere in the country, you're looking for a mortgage, Jeb and I's team here at Buywise under the United American banner can help you in about 18 states. And the reality is it covers about 80 to 85% of the inquiries that come in from the show. We are able to help you directly here with our team. So if you need a mortgage, if you need a second opinion, if you have a loan estimate from someone, if you've talked to someone, you think it's too good to be true, you think it's too bad, we're happy to look at that, give you a second opinion. And I can tell you, there's nothing more frustrating in the world than having another loan officer come behind you. We actually had that experience this week that someone we've been working with for about 6 weeks, helping them get a property under contract. They went back and had another loan officer review the loan estimate, and magically they'd agreed to cut $2,000 off their fees when they were originally I think 3/8 higher than us on interest rate. So when you look at that, that's frustrating. That is not what we want to do. We're here to be a service to you. What I can tell you is had a listener, I don't know if it's a live listener or just someone who watches Jeb's videos, because it came through Jeb's channel, reached out, a veteran in Florida, says, hey, I'm under contract. Will you look at this? They're telling me 7.25%. Is that reasonable? We look at it and we're like, no, it's at least 0.5% too high. So when we can save you 0.5%, we're absolutely going to step in and say, let us do the loan for you and get you those better terms. If it's 1/8 of a difference and you're in good hands and you feel like the person's treating you good and things are on track, we don't want to upset the apple cart. So sort of a little aside there. But again, we are able to review terms, make sure you're getting a good deal. If you feel like you're in good hands, definitely just give you some of that peace of mind. But if you're off on the wrong foot and you're getting overcharged, we can actually help you with that as well. On the real estate side, Jeb has an awesome network of realtors throughout the country. Use that link below if you're looking for a professional realtor, if you want a second opinion from that perspective, or if you don't have anyone, you're moving to a new area, you don't have friends and family who've worked with anyone. I can absolutely vouch for the agents in Jeb's network. I've never had a bad experience on a transaction with any of them. So with that, let's get back over here. Look at GD comes through with a super sticker. I didn't see a question attached to it. I think we answered a question for you earlier, but we appreciate it. Appreciate the support. Appreciate all of you guys being here. Got over 100 people here, even though we got the timing of the show set up wrong, and we've got a bunch of good questions. So let's get back in here, see if we can get them all answered. Guri says, I'm in Virginia in the DMV area buying a house with 7%. Good idea. I'm in the middle of the contract. We always say that rate and price is only relevant to the extent that you can afford it. If you are to the point in your life where you qualify for the home, you can make the payment without eating top ramen every night, and you have a need for that home. If you have arrived at the point in your life that it is the right time for you to buy a home, I'm not concerned about interest rates or prices. We may be in that 7% a little longer than what was expected, but we should, barring government spending, which you should be very well aware of in the DMV area. If you buy now, we should get an opportunity to lower that interest rate, but definitely be sure that worst case scenario, are you good with that payment at 7%? Seize the day. Another question here is a recast 100% guarantee. I'm worried about timing of buying a house, using funds to put 20% down to get offer, but need equity and sale of this house to put into final loan to make the payment affordable. No, it is not guaranteed. So if it's a significant amount, it is up to the servicer. Certain loan types do not even allow for a recast. So find out what type of loan you're getting. Ask the person placing the loan to reach out to the servicer, which there's no guarantee it stays with that servicer, what their policy is on a recast. But no, you will never have a guarantee. If it's a conventional loan, you should be able to do it. I've never had a borrower be turned down for it, but there's no requirement. So the other good news with rates kind of elevated, we're not back down at 6%. 7%, we're kind of towards the higher end of where things have been. Your worst case would be refinancing, a cash in refinance to pay that down. Smart Fox back with another question. In a market with a multiple offer market, can you as a mortgage lender vouch for your buyer or call the seller in order to get the house? Have you done that? We cannot talk directly to the seller, but something that your mortgage lender should absolutely be doing. Your realtor should be working with your lender that when an offer is presented, that lender is following up. I was on a live stream on my channel last night for Vetted VA with two excellent VA loan officers and a VA specialist realtor from the Memphis area. And we were going through this, and I asked Alexis, Alexis, how many loan officers call and follow up on the pre-approval letter with the offer? And she said, very, very few. During COVID, when things were nuts, it was common. Maybe 50% of them did. Now, 1 in 10, 2 out of 10. What I can say is it does a couple of things for your loan officer and you. It lets that agent know that it's someone that communicates. It gives them an opportunity to ask questions, get clarity. It's important. Is it the thing that's going to put you over the top? Not necessarily, but I wouldn't risk not doing it and missing out on a property that you otherwise might have gotten under contract. This is an interesting one here. Troy Yoder, I had a home and a building on the same mortgage. The bank released my home by mistake, leaving 2.6% loan on the building lot. We want to buy using equity from the home to build. Can the bank force us to correct their mistake? No, they cannot. You would, let me step back. I'm not a lawyer, so I can't tell you that they cannot, but you got to ask, what is their recourse? If there's no lien securing the home, and you get a title report and title insurance placing new financing on that property, there's no way they could force themselves back into first position. Again, I say no way. I'm speaking in absolutes. We haven't seen the deed of trust. We haven't seen the note. The deed of trust is what secures the deed of trust, or the mortgage, depending on where you're at, is what secures the loan to the property. They're long, 10, 12, 15 pages, a lot of legalese in there. I would read through it as closely as I could and see if it spells out what the recourse would be. It's fairly uncommon that there is a release of a portion of a loan. So you're in a unique situation, but I would want to read through the deed of trust or the mortgage. You should not have an issue. And especially if you go ahead and do what you want to do with no problems and they later discover their error, it would be highly unlikely that they could do anything recourse wise. And at that point, the title company would probably get involved. So Joyce back with another question here. Do you recommend a service like Dobby or regular insurance plan for routine home repairs? They can get pricey really quick between minor or moderate damages to the roof or replacing attic fans. Here's my take with anything insurance wise. It should be there for catastrophic things because insurance companies are there to make a profit. They are much better at analyzing the odds than you are. So they know what things cost over time. They've built their business model on making a profit. If they're making a profit, the person that's buying the insurance is coming out on the short end of the stick. So why would we do that? Well, why do we have homeowners insurance? Because I can't comfortably pay to put a new house on my lot. To rebuild my house, probably $500,000, $550,000, $600,000. I don't have 600 grand laying around that I want to allocate to building a new home. So that would be catastrophic. So we pay for insurance, despite the fact that the insurer is probably going to come out ahead over the long haul because the vast majority of homeowners never make claims to that degree. When we're talking about things that are not going to break you, that if you had to put a roof on your house, yeah, it's a big expense. You may not like it, but hopefully you can budget for it because almost all of these, they're going to prorate it. Let's say we're talking about damages to the roof and they come out and they go, hey, this is a 28-year-old roof with a 30-year lifespan. We're not going to give you a new roof. We're not going to cover all of the repair. This is sort of what you would expect with a roof that's 90% of the way through its life. So look at it that way. If you have no other way of paying for a catastrophic expense, it may be worth doing despite the fact that it's going to cost you more over the long haul. And that's the same for home warranty plans that, you buy a new home, the seller's probably going to buy a home warranty plan for you. And then when it expires, the home warranty company is going to try and sell you on renewing it over and over again. Same thing applies there. Scientist D, a very good question. Is there any meaningful difference between a 15-year fix versus a 30-year fix where I voluntarily make the same monthly payments as a 15-year fixed? The biggest difference would just be the interest rate. You're going to be paying a premium on the interest rate for the 30-year. So just looking at this, Mortgage News Daily says the difference between 707 and 65. Optimal Blue says between 6.86 and 6.189. So right now you're looking at a difference there between those two of what, a half to 3/4%. So if you take that loan, the benefit is you're paying less in interest. So it will take less of an additional monthly payment to pay it off in 15 years. The downside is you are locking yourself into a 15-year repayment. I would like to see more of an interest savings before I lock myself into having to make payments at that rate for 180 months. One never knows. Things happen. An unexpected expense can come up. You can lose your job. Someone can get in poor health. I prefer the flexibility of a lower payment and making the additional principal payments, but it's obviously going to be a personal decision of where you're at, what your discipline level is, and your comfort with the interest rates. Question and then kind of followed by a comment: is housing going to crash? Matt, go back and check earlier in the show. If you came in a little bit late, we've already talked about it. Don't really see a formula for that. Don't see a formula for prices spiking either, as affordability is low. But we have a lot of people with a lot of equity that own homes at very low interest rates with very affordable payments. That's not a recipe for distressed sales, which distressed sales are a requirement. A requirement. I will go out on a limb on that one. It's not much of a limb. Are a requirement for you to have a crash. You cannot have a crash without a significant amount of distressed sales, and we do not have a formula for distressed sales. Could we have a correction? Could we have a downturn? And to me, 10%-ish is a correction, 20, 25 plus is a crash. We do not have a recipe for a crash. Raymond's ruminations actually ruminates for us right here on interest rates. He thinks rates are going up. Go back and look at the chart in the beginning slides. If 4.34 breaches, you're going to be 100% correct. Well, Dixieland production. Jeb's going to be sad that he wasn't here to witness this. Has anyone ever told you guys good stuff? Just saying. I'm gonna do a snip of this part of the video. I'm gonna send it to him on his trip, just so he knows that you guys were thinking of him and sending good stuffs his way. Vise, I have a dream for all question. If you're outside of California, this will not make any sense to you. It's California only program through the California Housing and Finance Agency. Both incomes will not qualify. So my spouse, who is a first generation buyer, is going to apply a loan. Does this mean I can't be on the title or deed because my parents own a house? The first generation part is only one buyer. Everyone has to be a first-time homeowner on their home buyer on that program, but only one needs to be first generation. So you should be able to be on title. I would have to dig back into the guidelines and make sure that they may not allow someone to be on the transaction and not have their income counted. In general, that's not the way those work. We can leave income out, leave people off to not exceed the limits. I'm not sure Cal HFA works that way. Again, if you have that question, shoot an email to info@theeducatedhomebuyer. I'd be happy to go through that and get you a 100% definitive offer. Gabino Abarca, seller is offering $20K in credit. Would it be wise to apply the remaining funds to buy down the rate after closing costs? Home is $395,000, 30% down payment. So your only other option with those funds, other than buying the interest rate down, would be to ask for a price reduction. Say, hey, my closing costs are only $14,000. You're giving me $20,000. So either use the 6% or 6,000 to buy the interest rate down. And I'm just using 6,000 hypothetically. Either use that additional funds to buy the rate down, or go back and say, hey, I would like to reduce my credit and reduce the purchase price. The net for you as a seller is not going to change, but it puts me in a better position of what I'm looking at of monthly payment. So what's better, lower purchase price or a lower interest rate? Really just depends on what happens. For points, lenders are smart. They price their loans out knowing that when they have 1,000 or 10,000 loans, that on average, they're going to be on the books for about 5, 6, 7 years. So when they're paying a premium or giving a discounted rate for you paying points, they've built that into their model. But you are just one homeowner. You don't have that certainty of running 10,000 simulations of you owning that home and whether you're going to move, whether you're going to refinance, what happens next. if you were to get the opportunity to refinance in the next 5 years, you would have wasted much of the points paid to buy the interest rate down that you could have kept permanently by lowering the purchase price. So it really comes down to personal preference, where your comfort level is with the payments. Not a wrong answer there, but hopefully your mortgage advisor can pencil it out and show you that. If you're not working with someone or you don't have that figured out, you'd like us to help you with it, let me know. Seize the day. Back with a lot of questions here today. How quickly can you refi after the sale of a house? Worst case scenario of the recast question. So you will not have a prepayment penalty on 99% of the loans that are done in the United States. Your lender, whether they are a broker, a bank, direct lender, if it's going to Fannie, Freddie, FHA, VA, they will have what's called an early payoff penalty. So if I do your loan and you sell that house and in 90 days you have to refinance, for whatever reason, you can't get the recast done and you want to refinance in 90 days to do that cash in refinance, we're going to pay back everything that we made on that loan. So obviously it's suboptimal. Most of the loans we do are 0 points or close to it to the borrower. So we would have worked for free. So at a minimum, work with your lender, tell them, hey, this is what I'm thinking. This is my worst case scenario. And they'll work with you on it. That borrower I was telling you about that bought in the fall, I explained the same thing with that early payoff penalty. Said, just if rates are likely to drop, just give us that opportunity to get you to the 6-month, 181-day time frame so that we do not end up in a situation where we have that early payoff penalty. And he was kind enough to do that. It's worked out for all of us. So hopefully that was the answer to the question there. Kim, we will make sure that Jeb knows that you want he and his family to have a great time. I assure you they are. With 3 boys, it's hard not to have a good time. 3 very active boys, I might add. Guri, just back with a follow-up. I'm good with the payment, but worried YouTubers are saying market crash. There are some people who say the opposite. What are your thoughts on this bubble and market crash in 3 years? These idiots have been saying that for 5 years. Watch their most recent video and go watch a video from 2020. Same story, different day. You can sit here and say a stopped clock is correct twice a day. So eventually they will be correct, but you have to have an excess of supply and a lack of demand. I don't see any formula where we have an excess of supply. So from that perspective, I don't think you have a huge risk. I would be very careful about projecting. If we go back, home prices have doubled from like 2010. I wouldn't go forward 14 years and expect that your house is going to double. That's not a reasonable expectation. The only formula that I see for significantly lower prices is if rates went well beyond 7%. We saw that the market slowed considerably at 8%, but it also increases the lock-in effect. So you have even less people leaving their property or putting their property on the market. So stagflation would be a possibility there, where you have a terrible economy with inflation, so high interest rates and people losing their jobs. But again, go back to the slides at the beginning of the show. Everyone has a ton of equity. 40% of people don't owe anything on their home. They're not going to lose their home. They don't owe anything. They pay taxes and insurance. 60% of people that have mortgages, what was the number? 90% of them have at least 20% equity, and 60-something% have 40% equity in their home. I owe like 40% of what my home is worth. I have another property free and clear. There's no world in which those can become distressed sales. And without distressed sales, you don't have a crash. Wendell with a nice comment here. I bought my home in 2018 before the market went up. Thank God I got it as a veteran. The VA loan is far and away the greatest loan out there. We love helping veterans. Again, that link down there, if you're a veteran, non-veteran, buyer anywhere in the country looking to get qualified, get connected with a realtor, use the referral link. We would love to help you out. Like I said, we cover about 18 states directly with Jeb and I's team, and that covers about 80% of the inquiries that we get from the channel. Ooh, got an interesting one. Aquapedal says, I need cash for my current home to put down required cash with the new home builder, giving up 2.75 on a 15-year, already paid 5 years on this current home, need the space, scared to give up 2.75%. This is the situation where I wish Jeb was here. Jeb just went through this, had essentially the same thing, a 3% interest rate about 5 years into that loan, and his family had grown with those 3 active boys, didn't really have the option of staying there in that home any longer, and gave up that awesome interest rate for a higher rate and payment. And well, we're only 4 or 5 months into it. I can tell you he's very happy with that decision. They have more space. The boys love it, but it's going to be a personal decision, a personal call for you as to whether to do it. No one else can do it for you. Hopefully, a lender that you're working with can kind of pencil it out so you can quantify and know exactly what it is. And hopefully they can give you some insights into, is this reasonable or not? You said you're working with a home builder. If you're working with a big national builder and they're making you work with their lender by offering you massive incentives, they're not going to be able to help you with that. So maybe reach out to a local lender that has that level of financial acumen that could walk you through it. Elva, very good question. With the rules changing for buyer's agent fees, have loan agents talked about how this might change future loans for buyers? Well, it would be more accurate to say, have they stopped talking about it? If you look at any mortgage professional that has any form of social media, they're going to explain to you exactly how this is going to impact everything, despite the fact that we don't know anywhere near everything. I don't know if we don't know half of it yet. We know that buyers are going to have to sign a buyer's broker agreement. And that means that their broker is saying, here's what I expect to be compensated if I help you buy a home. We still do not know how sellers are going to react. Are they going to want to keep it status quo and say, hey, especially for first-time buyers, if you're selling $2 million, $3 million homes, you may be right in telling that seller, hey, someone buying that price of a home is going to be able to cover the cost of their broker. We go and we're looking at a $300,000 entry home, I can tell you that's my bread and butter of the audience that I work with. Those folks don't have an extra 2.5%, 3%, 2%, whatever the number is to cover their broker. So more importantly, the big pieces that we've been focused on, FHA came out this week and said and clarified that they don't consider that an interested party contribution if the seller is agreeing to pay that. So it is excluded from your 6% contribution. They're okay with it. They're okay with the buyer paying it themselves. So from FHA's perspective, they clarified they have no issues with any of the proposed structures going forward. Again, we've got a lot of veterans here. I help a lot of veterans. VA loans explicitly state that a veteran is not allowed to pay their realtor. You may not know this. You are not allowed to pay a transaction fee to a realtor. You are not allowed to pay them outside of escrow. If you are doing that and they say, hey, just pay me $500 over here, I pay my transaction coordinator, all of that's illegal. VA has not come out with any clarification, any change to their guidelines, and we are not sure how quickly they can do that. We have until July, so we're talking 3 months. That's crazy. In 3 months, it's going to be 4th of July. In 3 months, I don't know if that's enough time for VA to force through those changes. What the FHA released this week was essentially a clarification that the way the guidelines are currently written, they see no issues with any of the proposed solutions to buyers paying their own realtor or getting a concession from the seller to pay their own realtor. So hopefully that answers the question. John says, hi, so much information. Well, hopefully it was good information and hopefully information answering the questions that you have. Wendell back says there's a little bubble in Vegas. Our housing market is up here because of Californians moving here. Lots of areas can say that. You know, Arizona, Texas, Idaho, even Washington, Oregon have seen some of that. So just going through here, trying to get everyone's questions answered. ZL has an interesting approach. Says a crash only comes when it's not expected. That's how all crashes in the past worked. If every bro and their mom is calling for a crash, it's not going to happen. Probably some wisdom in that. You know, it's not a black swan event if everyone is saying, hey, there's a black swan flying directly at us. Seize the day. My husband and I are planning to temporarily use 401k house loan option, not a withdrawal towards down payment. You ever run into any problems with clients using that? We would repay after sale of our home. No issues whatsoever. If you're taking a loan against your 401k, whether you repay it later on or not a problem. I think personally that it is one of the best uses of your 401k. If you're young, you're 30 years old, and you're like, hey, I don't know exactly where to save. Throw all of your money in your 401k. When I say don't know where to save for buying a house, throw it in your 401k. Get the terms for the loan because you can generally save faster. It grows tax deferred. So you can take a loan, hopefully on a larger account than you would be able to save the money in a taxed account, probably in a bank account with very low interest rate, or in a taxable investment account, or in a Robinhood account or a crypto account. It's a very good way to go. I have never had a buyer have an issue with it. What I will say, the only potential problem is find out from, you didn't think you said whether it was your husband's 401k or yours, find out from whoever's employer, what happens if I have a loan outstanding and I lose my employment? I quit, I'm fired. Some of those things can trigger an immediate payment requirement. And if you can't pay that loan off in full at that time, it is considered an early withdrawal. So that would be the only downside to it. Doesn't sound like that's likely in the fact that you're only going to be using it for a short period of time. Joyce, let's do this. Joyce says, thanks for answering our questions. Can you put the link for the VA episode that you just did? Appreciate your time in the show. That is every Tuesday. We stream it on my channel, which is just youtube.com/@JoshLewisCMC. So every Tuesday we have that. I try to get one new video up a week on there, and we do 8 weeks on and then 4 weeks off with the live show with veteran experts talking about the VA mortgage and how it impacts buyers and sellers using VA financing. Wendell comes up with some terrible advice. Wendell, I thought we were friends. You've had several good comments here. It says, use United Veteran can help you. Veterans United is a giant marketing arm. They are the biggest VA lender in the country. We've said this before. I didn't mention their name. Wendell did. They're a giant call center. You are going to get a young, relatively inexperienced loan officer that works business hours in a call center. They're not going to be available on nights and weekends. They don't have the long-term experience to guide you. Most importantly for you as a veteran, they generally have significantly worse terms than you can get. So if you want to talk to Veterans United, say Wendell used them before and he's like, hey, I had a great experience. By all means, check with them, get some terms, get a loan estimate. Please check with the local mortgage broker. And whether it's VA or FHA, if you're getting a government loan, you've probably heard us say this on the show before, on a conventional loan, on a jumbo loan, the terms from a mortgage bank and a mortgage broker should be very similar. What we generally see is mortgage banks, whether it's a mortgage bank or a direct bank, they use the pricing on their government loans to subsidize the pricing and make it more effective or more attractive on their conventional product. So again, it's not to say that any channel can't give you a great loan. They can, but if you're getting a government loan, make sure you're at least checking with a broker because you're likely to get better terms. Joyce follows up here. Wendell, I used Movement, which was okay, I guess. I was planning to use Veterans United at first. So again, I would just go back to not a problem having a conversation with any of these people. And I'm sitting here saying you can generally get better terms somewhere else. Terms are important. Remember what we talk about here on the show. It's three-legged stool in terms of who you want to work with. You want to feel like they have knowledge and expertise. You want to feel like they're giving you good terms, not the absolute rock bottom terms. You would be shocked at how many people reach out and say, I want to make sure I'm getting the absolute lowest interest rate. You wouldn't go and think that you're getting the lowest price on the nicest car or the best heart surgeon, but people want to commoditize mortgages, and it's just not the way it works. Generally, when you go to the lowest price provider, you're not going to get the same level of knowledge, experience, all of that fun stuff. So in terms of that, by all means, check with every source. If you're referred to someone, I would say make sure there's at least one in the mix there. If you're talking to a bank, a mortgage bank, a credit union, make sure you're talking to a mortgage broker and compare those options and make your decision based off of those three factors. Who are you most comfortable with? Who do you feel has the most knowledge and expertise and is getting you attractive terms there? Guri, thank you for the super chat, $1.99 there. We appreciate it. We appreciate you being here and asking good questions. We have another one here. I may have not been paying attention. Destiny with another, it's $1.99 is the number for the day. I appreciate that, you guys. We appreciate your support and answering these questions or asking these questions so we can answer them. So Scientist D says, for USDA, if I put down 20%, do I still have to pay their PMI or whatever they call it? I can't seem to find this answer anywhere. We in Southern California as a whole, have very few areas that are eligible for USDA. So I cannot confirm that for you. My feeling is the answer is going to be no. It doesn't matter how much you put down. I would have to dig into the guidelines, which we have the handbook here, not hard. So again, shoot an email to info@theeducatedhomebuyer. We'll check that. Educatedhomebuyer.com. We will check that out and get you the definitive answer. But my gut says it's going to be just like FHA, that regardless of how much you put down, you're going to have the upfront mortgage insurance premium and the monthly mortgage insurance. So, Destiny, you actually had a question. I was complimenting you on sharing money with us and almost skipped over your question. So, Destiny says, I want to get a multifamily rental property that cash flows. I just got denied an FHA mortgage from high debt to income. What do you recommend? There If the issue is too high of a debt to income ratio on an FHA, there's generally not a good fallback. So previously, you couldn't do 2 to 4 units conventional without a larger down payment. As of the fall, owner occupied 2 to 4 units, you can do 5% down, but it's going to be more restrictive on debt to income ratio and probably have a higher monthly payment than an FHA would. So if you want to talk, you can fill out the referral form below. We can get you connected. If it's states that I can help, we can have that conversation. If not, we can get you connected with someone. But if that's truly the issue, if your income was calculated correctly, I don't know that there is an easy answer. Short possibilities would be a property that generates more rent, a lower priced property, but I'm sure you've already thought of that and looked through it. So wish I had a better answer for you, but not necessarily the one you were looking for, I'm sure. All right. I like this. So Sean says, I'm 17 years old, going into trade school, fortunate enough to have a college fund of 100K that I'll be receiving because I won't be spending it. How do I use this money to buy rental property? The key thing here is, where is the college fund? Is it in a 529? That's going to tell you what you're able to do. Did your family members, your parents, grandparents, whoever it is, did they just save in a normal savings account? It really depends on where the account is housed and what type of account it is. Generally, those accounts, once you turn 18, if you're not going to go to college, they can be transitioned into some type of retirement account. So again, too many details here to go into, and I don't want to give you wrong information, but I would believe there is a way to do this. If you want to reach out, again, info@theeducatedhomebuyer.com. We'll get you an answer to it. ZL says, if the VA doesn't update the guidelines before July, is it possible the VA buyers may be locked out of the market, and will it have any meaningful impact on the overall demand? No, VA loans, VA financing make up a very small percentage of the market, and it wouldn't, let's say they don't do anything by July and people start getting affected. There will be a large uproar among veterans that will talk to their congressman, and they will put pressure on the VA, and it will get resolved fairly quickly. So it may not be resolved by July, but it wouldn't be unresolved long enough to have any significant impact on the market. Felix, get this question all the time. Is there any reason why my mortgage lender keeps changed 2 times within 3 months? Generally, we haven't seen that as much over the last few years. When interest rates were changing rapidly, when servicing rights were very valuable, the servicing to these loans was getting sold very often, and you'd get a new servicer and get a new servicer and get a new servicer. Fortunately, there are a handful of mega servicers in the United States. So a lot of times your loan is sold or transferred, but it stays with the same servicer. But there's nothing you can do about it. There's no way to know when it's coming. Generally, it happens in times when servicing rights are much more valuable, or if a lender or servicer finds themselves in need of cash and has to sell off some servicing to get that. So I wish I had a better answer for you, but that is what it is there. I just looked up at 6:08. We were supposed to be done at 6, but you guys are asking good questions. So looking at this, Smart Fox, a great question here. Wish I knew you on my last loan. Do you cover San Diego or Vegas? I cover, for the most part, all of the very Western United States: Washington, Oregon, Idaho, Arizona, Texas, California, all of that. Nevada is an interesting one. We are working on getting licensed there. They have a very strict brick and mortar requirement. I can throw in with our team. We can also help you: Utah, Colorado, Montana, Tennessee, Florida. We get a lot of that, a lot of folks moving there. My personal licensing will be in place for Tennessee, Florida, and South Carolina here soon, but we have team members licensed everywhere. So when I say we're only in 18 out of the 50 states, but the reality is we're in the 18 states where people are. So most places that you're at, we can help you. If you're looking to get connected with me or connected to someone who does business like I do, can share the same type of knowledge and go through and help you make the best financial decisions, use the referral link and we'll get you connected with someone if it is an area where I am unable to help. So let's look here. Well, it looks like we just have a lot of comments from Wendell and Joyce talking about the VA loan. So I'm glad you guys were able to kind of chat back and forth and get some answers. So if there's not any additional questions, I will let you guys go. But we, again, 117 of you here, a lot of good questions, several super stickers from many of you. So we were probably a little more heavily mortgage related tonight without Jeb here to answer the real estate questions, but hopefully he gets his batteries recharged. The family is having a great time and he's back here to answer those questions. I'm actually heading to the desert this weekend as well, but for now, no such luck. I am here and talking to people on the phone and on the internet and all of that fun stuff. So again, appreciate you guys being here. We will be back next Wednesday. We'll be breaking down that CPI report. If you enjoyed the show, like, subscribe to the Educated Homebuyer podcast. Jeb and I actually had a little technological snafu. So next Tuesday's report, Tuesday's podcast did not get recorded yet, but we will be recording and releasing next Tuesday a breakdown of all of the issues that we're having with homeowners insurance throughout the country. So if you're a homeowner, potential home buyer, check that out. It's going to be a very good episode, and we're recording 2 episodes next week with 2 excellent guests. Lance Lambert from Resi Club and Ed Pinto of the American Enterprise Institute. Going to have those up probably in the next 2 to 3 weeks. You guys will really like them. So if you don't yet subscribe to the Educated Homebuyer. If you're here watching this on Jeb's channel and you haven't subscribed to Jeb's channel. If you want us to help directly, we've given the email address a number of times, but if you're looking to get connected with a professional and you don't just have a question, use the referral link and that will make sure we get you routed to the correct person. Okay, again, hour and 10 minutes. Appreciate you guys being here. Have a great week, and we will see you next Wednesday. Adios, amigos.